Hello, fellow rebel capitalists. I am back with my good buddy, Jeff Snider. Jeff, I've got a question for you. And I actually wrote this down, believe it or not. You know that I never, ever prepare for interviews or write things down.
I'm nervous now.
So my question is, what is going on with Verizon, Chipotle, Wendy's, McDonald's, CarMax, Amazon, Rivian, and Facebook? Just to name a few.
What's going on with those? There's not enough bank reserves. Haven't you heard, George?
There you go. There you
go. The Fed's doing too much QT, and now it's coming back to bite us.
All right, but explain here what's going on, how this is a reflection on the real economy. And then I want to take that and kind of parlay it into what's going on with the shadow banking, what's going on with private credit, and then we'll take that into what's happening with repo. And then we'll take that into what's happening with the Fed's balance sheet and if that's actually doing anything.
Yeah, well, I mean, what's going on in the real economy is just continued weakness, which is finally getting to the point, maybe even a tipping point, where we go from, we've been in this no hire, no fire environment for several years, which everybody just kind of dismissed as, oh, this is, it's not that bad. We don't see layoffs, so the economy must be fine. But, when nobody's hiring, that's going to lead you down the road to something bad eventually. We don't know how long it's going to take, but you get to a situation where there's just not enough income going around. It doesn't matter about price changes, that we don't have enough income being generated in the economy to pay for the price changes from 3 years ago, and people fall further and further behind. It's not just consumers. Businesses fall further and further behind. Plus, you add the fact that we never really recovered in 2021 and 2022. It looked like a recovery because prices soared ahead. And so it created this illusion of recovery. So what you have is, and what we've had is over the last several years, businesses thought there was going to be this roaring, booming comeback from the pandemic. All the governments had done it. The Fed, the federal government, the Europeans, everybody. They had thrown a bunch of stimulus in the pot. It was going to create this massive recovery wave. We saw it in consumer prices. It looked like it was inflationary. So businesses did what they always do. They see all these signals, they hear from their economists, and they start hiring people, anticipating that there's going to be a recovery. But it very quickly, by 2022, they figured out this isn't a recovery. It's an illusion. And that they had actually hired too many people. But rather than fire everybody right away back in 2022, they said, well, maybe over time the economy will come back. And so, yeah, we've got too many workers on our books now, but eventually a demand will come up and we won't, we'll have something for them to do. We don't really want to get rid of them in case we're wrong, because we just went through hell trying to secure workers, the labor shortage in 2021. So let's just hold on to the workers, but obviously we don't need to hire anybody else. We've got more than enough employees as it is. So hiring just stopped. Everybody had more than enough employees, but what that meant was there just wasn't going to be enough private income circulating through the economy. And slowly over the next couple of years, even though we didn't have layoffs, there was no hiring, and people kept falling further and further behind because there wasn't enough income circulating. And eventually you get to a point where, first of all, those employers are going to say, we still have too many workers. We don't actually see demand coming up like we thought. So let's start getting rid of some of them. It's not just a no hire, no fire environment. Now it becomes a no hire. Hey, let's start firing some people. And the danger with that is, where you get into the traditional recession mechanics, is that when you start firing some people, it pushes the entire economy, especially the consumer economy, past the tipping point, where you go from no hire, no fire to no hire, some fire to no hire, a lot of fire really quickly. That's what, the flat part of the beverage curve.
And that's usually when you get the unemployment rate spike.
That's what, because it's nonlinear. That's the other thing you got to keep in mind, that this is kind of like a parabolic increase where you're, for the last couple of years where it's no hiring, the parabolic increase was the part, that you can barely detect. And all of a sudden it just kind of starts to go up like this. So the danger is with Verizon and Chipotle and Amazon and UPS and all these big name announcements that are cutting tens of thousands of jobs, is that we might be at that point where we're going from no hire, some fire to no hire and a lot of fire. That's the risk. It's not confirmed yet, but I mean, the Challenger data, all the labor market data from ADP and a bunch of others suggesting that the job shedding has accelerated here.
Yeah, the way I look at it is you had all of the government distortions from 2020, 2021, and demand did skyrocket. There's no getting around that. So aggregate demand goes up, and then you've got a restaurant owner, and they've got a line out the door every single day for lunch, and you can't get a reservation for 3 weeks. So they're thinking it's because their restaurant's awesome, not knowing that it's did all these government distortions. So of course, what are they going to do? They're going to hire more employees, and they're probably going to set up more restaurants. They're going to borrow money. They're going to, they're going to try to build, or they're trying to buy a space, or they're going to try to set up more locations, because obviously my pizzas are the best thing in town. And then you start getting this reality where aggregate demand starts to go down because prices have gone up, but wages haven't kept pace. And then let's just say the stimulus, whether that's in the form of not having to pay your rent, PPP, and outright check, that starts to go away, or you don't have it anymore. So then you have this reality, and I always just do this, right? Because prices go up, wages stay the same. So you get that spread that people start to see, and they're like, wait a minute, my overall purchasing power is less than it was in 2019, even though my nominal wages might have gone up slightly. So then you have aggregate demand go down, but then the businesses still think they're great, and they still remember the demand for 2022, and they still think that that's coming back very, very soon. Especially, remember, Jeff, when the Fed drops interest rates, then all that demand is going to come rushing back. So we're going to hang on to the employees. But as the aggregate demand decreases and decreases and decreases because people's purchasing power shrinks, finally, the businesses realize that even if we want to keep these employees, even if we think this demand is coming back, we can't afford to. We're between a rock and a hard place, and we've got to go ahead and pull the ripcord. So that's how I would describe what's happening.
Yeah, and George, the process of coming down, I mean, we had so many unique features of the pandemic. I mean, so interpretation was going to be difficult to begin with, because we don't really have a lot of, history to rely on, at least certainly not living memory. So as that process took place, it was a slow thing. It wasn't like, the restaurant was booming and then the next day it wasn't. Right. The restaurant was booming, and then the next day it's still booming, but it's a little bit less. And then 2 months later, it's just a tiny bit less. And so for business owners, you can see what they were thinking, like, okay, it's just a little bit of a soft patch. We just get through the next couple of months, and everything will start soaring again. And then the soft patch got a little bit softer. You think, okay, it'll turn around, maybe in a couple of months down the road. And so everybody just, kind of didn't really know what was going on. So you turn on the TV or you go to social media, and Jay Powell says everything's fine, don't worry about it. And CNBC says, look at the stock market, everything's booming. It doesn't matter what president's in office. They say the economy is roaring. So you think, okay, we were booming, and then it got a little softer. Maybe things will just pick up and turn around, next day, next month or next year or something like that. So there wasn't that dramatic V-shaped downturn where, everybody just said, okay, we got to start firing workers because demand fell off and it's not coming back anytime soon. Mm-hmm. It's just been this slow, it's almost like the proverbial boiling frog, right? The downside temperature got turned up a little bit at a time. And before anybody really realized it, it was like, okay, now things are we're way behind.
Yeah. Another thing that I've been thinking about that ties into what you're saying in this whole cycle is, let's just assume for a moment that real GDP has been 2%. We'll just use that just as for easy math. But a large part of that 2% that we have had over the last, let's say, 3 or 4 years has been a result of fraud, quite literally fraud. And so, even if all else being equal, if you eliminate the fraud, then that's going to have a massive, massive impact on the real GDP, whether it's positive or whether it's negative. So when you combine all the fraudulent collateral, all the loans that were made that otherwise would not have been made because the tide was in, let's say, and the tide was very, very high. So the higher the tide is, the more people can go out there and swim naked. So we have all these people swimming naked, but those people that were swimming naked were the reason why GDP was maybe positive instead of negative. So my point here is that even if, all is the same, if we have less fraud and we have less credit extension, then that's going to have a huge impact on GDP. And that in of itself could take you into an economic contraction. And that, I guess, just exacerbates what you're talking about with the bullwhip effect, with all of these real world companies like Verizon, Amazon, Chipotle, Wendy's, CarMax, etc.
Yeah, and it's, the idea that you fake it till you make it. I mean, that's exactly what you're talking about. Let's be honest here. The fraud was part of it. You go back to 2021 and 2022, they didn't care. All they cared about was that money was out there in the economy, because all the Keynesian economists told it doesn't matter how the money gets out there. As long as it gets out there, it's going to get spent. It's going to create the recovery. Right. All government stimulus is literally fake it till you make it. That's why stimulus never works, because that's not how an economy works. So the fraud was a huge part, and that's why nobody cared. That's why the government didn't stop. I mean, yes, the cronies were getting rich off of it, but that's part of it. But nobody cared that there was a tremendous amount of fraud, because from the government, a purely Keynesian economic perspective, it does not matter. You go back and read Keynes' general theory. That's what you do. You just throw money out there, and after it goes and circulates through the economy, it's supposed to lead to a virtuous circle that becomes a recovery. That's not how an economy actually works, but the fraud was part of it. And eventually, the economy gets to a point where it can't just simply operate on fraud at the margins and create a sustainable advance. And that's where we've been moving toward that for the last couple of years, but more visibly the downside effects of it really since last summer. But what really got the Federal Reserve to start cutting rates was finally realizing that the economy that got further enough away from the fake it part of it, the fraud part of it, just did not look like it was supposed to. It was supposed to be taking off and accelerating, and instead, no matter which way you looked, it was decelerating. Not just a U.S. problem. You could see the same thing happen across the rest of the world too. So you had this deceleration in 2024 that surprised the hell out of everyone, which is why central bank rates started to go like this. Remember, it was going to be higher for longer. I mean, everybody said, rates are going to stay up here. And then they said, well, no, we got rates where we want them. We'll just leave them there for a couple of years. And that never happened. They left them there for a couple of months. And then all of a sudden, all these central banks are starting cutting rates. That was why. They expected that the stimulus would lead to second and third order positive effects that would lead to an accelerating recovery. And then that, got delayed into 2023, and then it got delayed into 2024. And you get to 2024 and things are really starting to decelerate. They're like, okay, now we got to start cutting rates again. So the fraud was part of it. It was supposed to be a major issue or major factor leading to the recovery, which just blows your mind that they actually think that way.
Yeah, but the point there that I'm trying to make is, once the tide goes out a little bit, you see that there is this, and I'm talking about the banking system, the monetary system. So they see that there is this fraud that they kind of papered over or just ignored before. And now all of a sudden they have to pay attention to it, because, okay, well, if that's bad collateral, then maybe all these other loans have bad collateral as well. So I'm not going to lend at all until I figure out what's going on. And that in and of itself makes the tide go out even further. And expose more people that are swimming naked. Yeah. And then the more people that you see that are swimming naked, the more the banks pull back on credit. They tighten lending standards. They reduce liquidity, and that just makes the tide go out even further. And I think that's kind of the point in the cycle where we are right now. So then the question becomes, okay, if the Fed does QE, will that make the tide come back in? And it's an honest question. I think you and I have the same view on this, but what would your answer be?
No, of course, QE doesn't do anything. It's good for the news media. It's good for the Federal Reserve to say it's doing something, but even its proponents, they can't really find any effect.
Why does it not do anything,
Jeff? Because it doesn't fix the problem that we have. And let's go back to what you just said, George. Before you get to the tide going out, you have to understand just human nature. We see these same things in every bubble cycle in human history. People have this innate ability, maybe it's evolutionary, to fool themselves. We rationalize good things because when good things are happening, when it's fun, everything, it's always fun on the way up, right? And you never want it to end. So all these credit providers, whether they actually believed it was fraudulent and, faked and everything else, didn't matter. It gave them cover to do what they wanted to do, which was just to make as much money as they possibly could while they could.
Yeah.
So while Jay Powell's on TV saying solid, strong and resilient economy, solid, they said, I don't really see it in the credit scores on people I'm looking at, but I don't freaking care. Jay Powell says so. I've got legal cover. I've got collateral. It's not real collateral. I've never verified it, but I've got theoretical collateral. Boom, deal after deal after deal, volume. So while all that's going on, and while this story that's created in the mainstream about a booming economy, as the stock market continues to go higher, that just adds more to the rationalization. As long as that continues, the stupidity gets stronger and stronger and stronger and stronger and stupider and stupider and stupider.
And Jeff, real quick, I just want to point out to the viewers that deal after deal after deal is creating aggregate demand in the real economy that gets
more fake.
That's completely artificial. It's a sugar rush, and inevitably it's got to come to an end.
So the point is, when you get to stupid, and it just piles up and it piles up and it piles up, and it's, we have all of this collateral that's supposed to make everything safe, but it's actually a bunch of dumb collateral. It's fraudulent. Nobody's ever bothered to look at it.
Right.
So when you get to the tipping point where things go to the other side and everybody starts to say, oh, hold up here. Now we're at the point where we have to actually look at details and scrutinize reality and look at things, and we don't like what we see. It's almost like once the toothpaste is out of the tube, you can't get it back in. So even if QE was money printing, it still wouldn't matter, because the tide has shifted and risk taking disappears, because there has to be, everybody knows. Everybody in the system knows. Everybody knew it while it was taking place. There's going to come a day when all this stupid's going to come back on everybody, and we have to start apportioning losses. So this thing is done. Doesn't matter what the Fed does. Doesn't matter what the Federal Reserve does or the federal government does. This thing is done. The credit cycle has shifted to the point that the only way to restart it is to get everybody to assign the losses and be relatively sure that the losses have been assigned, and we can start fresh all over again. That's what a recession cycle is really supposed to be. It's supposed to clean out all the stupidity and kind of start again. Now, you hope the recession, the downturn isn't bad enough. You hope you don't go into a liquidity crisis, but that's what a contraction is supposed to be. It's getting rid of all the idiocy and, expunging it from the system so that you can start fresh all over again. So again, we're at the point where we're just at the top of the top of the Minsky curve, where everybody's taking a look at what all the stupidity that's been taking place and thinking, oh, we got a long way to go to the bottom. So, now we're looking at collateral, we're looking at actual lending arrangements. We're actually going to scrutinize, what the economy is doing, not just take Jay Powell's word for it. And so there's not a whole lot that's going to happen here that's going to be able to turn everything around and just get everybody to say, oh, forget about all that stuff we did that was really stupid. Let's start taking more stupid risks again. So
it's a self-fulfilling prophecy, because
it has to.
Yeah, because then they tighten the belt. The credit providers, the liquidity goes away, and that makes the problem that much more worse.
And it doesn't, right, George? It doesn't matter where it comes from, because it could start over here, it could start over here. It's just like, wherever the snowball starts or the spark gets, lights the fuse. That's again like 2008. It wasn't really about subprime mortgages. They just happened to be where this thing started. It's the same process every time. So once the downside of the cycle hits, it does become self-reinforcing, because every action leads to a reaction. It's a positive feedback loop where every reaction produces a greater response, and then a greater response, and then a greater response. And it just kind of spreads and filters out from there.
Yeah, it starts at Tricolor, and it goes to First Brands, and it goes to UBS hedge funds, and it goes to layoffs, and all these things combined. If you're a dealer bank, you're just seeing risk or counterparty risk just go parabolic. And so let's just say that you've got an extra $1 billion worth of bank reserves, is that going to really impact your decision-making process if you see risk going straight up? I think the answer is no. The example I use, I'd like to get your take on this, just to kind of try to keep it simple for people, is I always say, assume that you're a hard money lender, because most people can get their head around that. And it's, you make money on taking a set amount and lending it to a real estate investor. Okay. And let's say that you've got $10 million. And let's just say that the housing market is declining, and therefore lending to these real estate investors is becoming more and more risky. Well, you've got one of two options. You're either going to increase your interest rate, because you've got to be compensated for the additional risk. But most likely that increase in the interest rate is going to make it prohibitive for that person to borrow the money, because then the math doesn't pencil out. Or you can just not lend. Now, is the problem that you don't have any money? Is the problem that you don't have enough money? No, that's not the problem. The problem is that risk is going straight up. So even if the bank comes in and says, hey, I want to give you an extra $5 million. Okay, great. I can't even use the 10 million that I already have. And then to make the example more realistic, we have to remember that the banks create their own money. They create their own credit. They create their own liquidity within the banking system itself. So I think that's the example I use to try to illustrate why it's all about risk at the end of the day. And the QE stuff, it really doesn't impact things mechanically, although psychologically, I think maybe there is an argument for the perceived counterparty risk going down, just because people think that if the Fed is doing something, then maybe that matters.
Yeah, there's all sorts of literature that's, the academic, the theoretical benefits of QE are, portfolio effects, psychology, and interest rates. And the reality is that all of these academic studies, they never really find any statistically significant effects in any of those, including psychology.
Really?
In fact, psychology is supposed to be the number one thing that QE does. It's not money printing. It's not bank reserves. It's supposed to, not just even the banking system or even the financial markets. It's supposed to have people in the real economy thinking the Federal Reserve is doing something big, and it's accommodative and it's stimulus. So I don't need to know what it is. They just know that the Fed is doing it. CNN or, CNBC or Bloomberg tell me that they're pouring trillions of dollars into the economy, which, by the way, is not true whatsoever. So they're pouring all this money in I should start spending and investing and hiring people because this is going to help me in some way. That is the true channel by which QE is supposed to work.
Yeah, that was my point. That was my point.
Yeah. So, but what you said, George, is exactly the case. And we have to keep in mind, in a ledger money system, as you were just pointing out, money is created and then lent into existence. So if I to create money and I have to lend it to somebody, that means I also have to take into account the probability that I'm going to be paid back. So even if I've created money, I've created a loan, that loan doesn't get paid back. That creates a loss, an accounting loss that becomes a real thing on my balance sheet, which then creates all sorts of bad consequences for me. So even though I have this money printer that I can create ledger money, it is not risk-free, and it's not as easy as just printing money and then sending it off on its way. So you have to take into account the overall credit and economic climate that all this stuff takes place. So if you can create money, but you think, I can create money, what am I going to do with it? I'm going to lend it to somebody on crappy collateral that I don't even know. No, it doesn't matter how much money you have or have the ability to create money. It's the overall economic climate, which, by the way, is why economists and central bankers spend so much of their time and effort on psychology and emotion and sentiment, because sentiment is a real big deal. The problem is sentiment alone can never overcome previous stupidity, right? You can't just get everybody to think happy thoughts is going to magically erase, 4 or 5 years of epic stupidity. It's just not going to work that way.
Right. So your other option there is to increase interest rates. And I think that takes us right into repo. So do you want to explain kind of what's been happening with the SOFR rates and why that's atypical, and then go into the usage of the Fed's standing repo facility?
Yeah. So the Fed has a standing repo facility, which is really like the discount window. Except with some features that make it a little bit different and more usable. So it's basically supposed to be sort of a lender of last resort. Repo, for people who don't know, is just secured, collateralized interbank lending between counterparties. So it's supposedly the safest interbank lending and wholesale market that's out there, and it really is. I mean, for the most part, there's really not a whole lot of risk in lending treasuries. Your biggest problem is getting the treasuries back when you have collateral shortage, but repo markets are huge. You also have to keep in mind, I point this out all the time, that there is no single repo market. There's several, and we really don't know what's taking place in the majority of it because there's no information. There's no real tracking. So the information that we do have it's sort of a proxy for what the overall repo market is.
Several repo rates too, aren't there? Yeah, like each counterparty has its own repo rate, and then we just take an average, right? That's
what I'm going to get into next. So there's not a single repo market, and there's not a single repo rate. The repo benchmark that the Fed comes up with, SOFR, the secured overnight financing rate, is not a single rate either, just like federal funds is not a single rate. Mm-hmm. There are many different, there's hundreds of thousands, probably not that many. There's thousands and thousands of transactions that take place every day in repo. And so the Fed kind of it looks at all the transaction data and says, what is the weighted median of all of these transactions that take place? So there's a dispersion, and it can be a relatively wide dispersion in the marketplace. What has been happening over the last couple of months, really going back to July, is that repo rates have been creeping up more so at the top end, which means that borrowers who are judged to be either too desperate to borrow funds, or they have less good collateral that they're presenting for to be posted as collateral for their arrangement. the market has been tightening up and tightening up and tightening up. But part of it is too, there's just less cash circulating through the system, which is what George's point is getting to be. That money dealers who are responsible for relending and recirculating funds, not necessarily bank reserves, it's also private ledger money. So recirculating funds through repo, they're less willing to do so. So those who have cash in the system, alongside those who circulate the cash in the system, are both increasingly, don't want to make too much out of it, but they're increasingly risk averse. They're increasingly pessimistic about all sorts of things, not just in the repo market. So things have tightened up. The money suppliers have made less money available in the marketplace, and the money circulators, the dealers, have made less money circulate through the marketplace because there's risks to doing both of those activities. Right. And as the perceived risks rise, they want to do less of them because, as George said, the only way around that is to charge a higher rate, which is what we're seeing in the repo market. So repo rates have been creeping up a little bit, and they actually they got a little bit out of hand toward the end of last month into the early part of this month, which suggests that there's something going on, some monetary tightening in this key wholesale marketplace called repo, that suggests that there is more to the story than just quantitative tightening or just an overall benign environment where everything's just completely fine and this is just a bunch of technical matters.
Mm-hmm. And I think it's funny when you say, George, it sounds like we're someone else is asking you the questions and we're just splicing this in, but we're doing this live, guys, I guarantee. But that takes us into, I think, another topic of discussion, which people get very confused and actually people get angry about. And that's why deficits and debt expectations don't really impact interest rates, but growth and inflation expectations do. And because about a couple minutes ago, you're talking about how that bank or financial institution, they have some options there. And if risk is skyrocketing, do they really want to take on that counterparty risk that entity isn't going to pay them back? So if they want to expand their balance sheet, the other option that we didn't talk about is buying treasuries, where you don't have to worry about that counterparty actually paying you back. And that's going to impact yields. That's going to impact the curve. That's going to impact a lot of different things. But that's really what's going to drive the decision making. It isn't necessarily going to be the bank saying, well, the counterparty risk is going up. I could lend into the real economy, but or I could lend to treasuries. But there's no way I'm going to lend to the government and buy treasuries because the deficits are going to explode. Because at the end of the day, they don't care because they're just pocketing a spread between the liability side of their balance sheet and the asset side of the liability balance sheet, the asset side of the balance sheet overall. So can you kind of explain that and then tie it into what we were talking about?
People do get angry about it, and they get angry about it for the right reasons, right? The federal government is absolutely insanely broken. It's getting worse. It's not getting better. The problem is people immediately think, because they're told repeatedly by everybody, that this is a problem for the Treasury market. And it's not a problem for the Treasury market. It's a problem for everything else, but it's not a problem for the Treasury market. And if the last 20 years of absolutely insane borrowing didn't disabuse people of this notion, I mean, at this point, it's just ingrained in there. And I think a lot of it has to do with everybody hopes that the Treasury market will blow up, because nothing else is working. Nothing else is getting both. It's a bipartisan problem. It's not a Democrat or Republican problem. They both do it. So if the parties aren't going to solve this for themselves, then the Treasury market has to blow up to put a stop to this, because this is just utter insane madness. And it is. The bigger the federal government gets, the more the government is going to interfere in everything, because it has more money. It has more ability to influence everything. Right. That's why people get so angry. And they're absolutely right to get angry. But it does not follow that the Treasury market will necessarily blow up because of the federal government deficits. And that's the part I think that people, if you're thinking rationally about everything, then it's much easier to come away from the emotional aspect of it. Just to compartmentalize for a second and say, okay, this is what we would like to happen. It doesn't necessarily mean that's what's going to happen. And the reason is because, as you just said, George, if you're a financial person, if you're a financial manager, a reserve manager, it doesn't matter what, you're managing money and your alternatives are a bunch of risky assets over here, If you're a bank or just an investment fund, it doesn't really matter. You got a bunch of risky assets over here, and you've got a bunch of perceived safe assets. By the way, safety isn't necessarily credit risk. It's the fact that if I sell this asset, if I have to sell this asset tomorrow, will I be able to sell everything that I want to at the price that I want to? The reason why treasuries are considered the safest instrument is because they have the deepest market. They have liquidity characteristics that are second to none, and even those aren't perfect. But that's why treasuries are the preeminent safety instrument. So if your alternatives are to lend into credit markets that may be on the downswing of a credit cycle with epic stupidity embedded in it, or just parking some money in treasury bills and getting, a couple percentage points while you still can, or maybe even shifting further down the curve and say, hey, the 30-year bond here at almost, 4.5% or 4.6%, that's looking pretty good if things continue to go badly. Maybe I should lock that in here. The alternative makes sense. You're not thinking about the government paying back its loans because it doesn't necessarily need to pay back its loans. It never really has. So you're thinking about the credit profile of the federal government. You're thinking about as you said before, the growth and inflation expectations in the real economy and what those means for the overall marketplace over the time period that you have as an investment horizon. So whether that's a couple years or 5 years or maybe even longer, you're thinking, if the credit cycle has to go in the wrong direction, I don't really care about the returns in the treasuries. I'm going to get some percentage point return for the next little while. I'm just going to sit myself in a 5-year treasury and not really worry about, the federal government deficits. Doesn't really matter to me. I'm more concerned about the risk that's taking place, or the reality of the downside credit cycle that's likely to take place and get worse as we go forward in time. So the marketplace is completely detached from the idea that federal government deficits are going to be some major problem at some point. There may become a time when that's a big issue, but that's so far down the road that it's not even worth considering for people who are participating in the market today, which is why you have these inverted curves. What the inverted curve is saying is that all these people in the marketplace, not just banks, financial counterparties, wealthy individuals, doesn't matter. They're willing to take less of a return for a longer run treasury because they know, or at least they're reasonably sure, they see the probabilities of risks becoming more than risks on the risky side of the ledger.
So the pushback there is going to be right, Jeff, but at some point, this is all going to unravel, because if the economy is deteriorating, if the stock market is deteriorating, the labor market's deteriorating, we could go into a 1970s type thing, and you're not going to buy a treasury at 4% because you know that inflation is going to go up to 10% or 15% or whatever, and your purchasing power is actually going to decrease. So there's no way you're going to buy a treasury in that environment. So you're likely going to buy gold, or you're going to buy silver, or you're going to buy Bitcoin, whatever they insert into the equation. The way
that assumes that everybody agrees with you, right? You're assuming that inflation is happening when nobody else agrees with you. The marketplace says, I don't see any inflation. You may see inflation, but you're wrong, because the market says, I don't see any inflation. And by the way, that's not why gold is going up, and that's not why Bitcoin is going up either. So people are inferring from these market signals what they want to take away from those market signals. They say gold is rising. That must mean because 1970 style inflation is coming. Well, gold was rising pretty sharply before the 2008 crisis too. And everybody at the same time said the same thing. They said, oh, look, inflation. And then when oil prices skyrocketed, they said, see, it's 1970s all over again. And what happened? We had the 1930s.
Well, we did have inflation. I mean, to be fair, the CPI from
but that wasn't
07.
Not inflation. That was not inflation.
But you had the CPI go up. The CPI went from 3.6
but that was a misleading signal that fed into all of these biases. People thought that what they were talking about was that gold was signaling, like what you were talking about, an era like the 1970s where inflation was going to be out of control and a persistent problem that was going to lead to the debasement of the currency, right? That's what everybody said when gold was going up in 2005, 6, and 7, and even into 2008, though gold had a little bit of a problem there with the deflation. It's the 1970s all over again, but it wasn't. It was the 1930s all over again. So what I'm saying is the actual marketplace where interest rates are traded, the most sophisticated market there is, the biggest markets there is, they are uniformly saying that interest rates are going to go down and go down by a lot and stay there for a long time, which is the opposite of an inflationary environment. So people who are convinced that we're heading into an inflationary environment have to realize that the entire marketplace, the entire monetary system disagrees with that assumption. And so if you're understanding that, you look at gold and say, well, if that's not the case, if we're not heading into 1970 style inflation, why is gold going up? And I just answered the question for you. The same reason that gold was going up in 2005, 2006, and 2007. People were using gold as not in a currency alternative to shelter from inflation, but as a safe haven asset to shelter from the downside of a credit event after epic stupidity had infected the entire global marketplace at that time. Gold wasn't going up for inflation. Gold was going up anticipating deflationary circumstances, which is, by the way, what we got. I think what the problem most people have is they're not interpreting these signals in the way that they should be interpreted. And a lot of it has to do with just all the junk science and junk economics that are out there.
Hey guys, if you're watching this video right now, you probably know the stock market, the housing market, pretty much every market is in a massive bubble right now. The Fed is totally out of control and the debts are exploding. You know this doesn't end well, but the question is, what do you do about it? Well, fortunately, I've got the answer. Now, let me be clear. If you're the average retail investor just watching CNBC and trusting the system, this definitely is not for you. But if you've been sensing there's something wrong and you're looking for clarity through all of the chaos, then Rebel Capitalist Pro is your unfair advantage. What is Rebel Capitalist Pro? It's the private investment community that I have with my good friends Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Seresna, and Jason Hartman. It includes private member-only live stream Q&As that gives you direct access to the pros I just mentioned. Also, proprietary research from Lynn Alden and Chris McIntosh, model portfolios, exclusive whiteboard videos, and best of all, the Rebel Capitalist Pro community. Rebel Capitalist Pro is basically the cheat code you need to not only protect your wealth, but to build wealth and thrive in this crazy world of asset bubbles, out of control central banks, and big government. So stop worrying about this stuff. Stop losing sleep and start investing with confidence. For more information about Rebel Capitalist Pro, we'll put a link in the description below this video. The way I like to describe it, I just did a presentation on this at the New Orleans Investment Conference. And what was interesting is I was talking about why debt and deficits don't impact yields and why they haven't in the past, most likely, and then why they probably won't in the future unless the whole monetary system changes. And the people that are all gold bugs, by the way, you know, all 750 attendees are mostly gold bugs. They all enjoy it. You know, they came up afterwards when I was walking out in the halls. They're, oh, I loved the presentation. It was great. It was awesome. The people that were really quite literally angry were some of the other speakers. I'm not kidding, because we had like a VIP lunch after I gave my presentation. And there were a couple guys that were like shaking. Like, I'm not kidding you, Jeff. They're literally shaking, because what I was implying is that the deficit.
They didn't know what the hell they were talking about.
Well, probably, but the deficits don't matter, right? And again, I want to be very clear. The deficits matter because the government spending distorts the economy. This is no free lunch. This is no free lunch. But what we're saying is the deficits and the debt don't matter in terms of interest rates. It is what it is. And so these guys, their entire worldview, a lot of these guys were 70, 75. Their entire worldview, and they've been saying this for 40 years, revolves around debt and deficits mattering to yields, to interest rates. So if they don't, it's like their whole world and their whole identity really comes crashing down. And that's why they get so heated and they get so angry. But the core of my presentation was kind of looking at it through the lens of a bank. And what I tried to get people to think about was that banks really aren't taking their own money and buying treasuries. It's just the spread. It's the spread between the liability side of their balance sheet and the asset side. So if they are let's just say, creating deposit liabilities at 2%, and they can buy a Treasury at 4% and then match up the maturity, right? Why not? Like the only reason they wouldn't do that is if there was a better opportunity to take that balance sheet and create money and create loans in the real economy. And if the risk is going sky high, then it's an obvious play to go ahead and buy Treasuries and pocket that 2 or 3% guaranteed spread. So if you're just pocketing a spread, you don't care what the inflation rate goes up to. It doesn't matter. You don't care what the deficit is. You don't care what the debt is, because you're literally making free money. And I start by asking the crowd, if I gave you $100 million over the next year, would you accept it? And they'll say, yes. I say, but wait, there's a catch. What if I told you that over the next year, the CPI goes up to 10%? Would you still take the 100 million? They say, well, yeah. And I said, but wait, there's a catch. What if I told you that the deficits are going to go up to 10% of GDP? And what if I tell you the debt is going to go up to 40 or 50 trillion dollars? Would you still accept the 100 million? Oh, yes. I'm like, but there you go. That's why debt and deficits don't matter. It's because you have to look at it through the lens of the commercial banks, especially in the Eurodollar system, which, based on my view, are the marginal buyers and sellers. And that's why I think, and correct me if I'm wrong, if you look at a chart of nominal GDP in the US going back to like the 1950s, and you put that and you include a chart of the 10-year Treasury yield, it's like it tracks. It basically, the 10-year Treasury yield is a smoothed out curve of nominal GDP. So I'd love to get your thoughts on my view and my explanation for this, and then tell me if I'm right or wrong, and then kind of expand on why it is in the past that we've seen the 10-year Treasury yield track so closely with nominal GDP in the US.
Well, that's what you would expect it to do, right? I mean, that's growth and inflation expectations, and it's not a perfect track because there's always short-run fluctuations, and short-run fluctuations can be several years. But George, I think the biggest problem here is that economics is an incredibly complex topic. And so what happens is that you have all of these shorthand myths that get that people go by, right? They hear one thing, the future is unexpected, and the future is difficult to predict as it is, even if you have a high degree of knowledge and a high degree and high quality data series. This is a very difficult thing to do. So a lot of people go by simple phrase. It's almost like a heuristic look at the entire discipline. You have these simple ideas. Okay, if this happens, then we should expect this.
Yeah. Right.
So if the government does this, in the past, a couple governments have blown up their marketplaces, right? The example you come up with currencies that everybody talks about is Weimar Germany. If you print money, the currency gets destroyed, right? So people use this heuristic approach, this overly simplified approach, and they think if this happens, then this must be the result. When they don't realize there are so many different examples and so many complexities and nuances that it isn't so simple. If you see governments go into insane amounts of debt, that it inevitably leads to a financial collapse. But that is a heuristic that everybody just accepts because they don't know economic history. And the economic history they get are from people who tell them this is what happens. If this happens, then you should expect this result. And that's the biggest intellectual problem that we have. And by the way, we have all sorts of examples that show that that's not the case. Everybody says, oh, fiat currencies all blow up. Well, the U.S. government repaid the greenback after the Civil War. That one didn't blow up. We have that in our own example, in our own history that people never talk about. The 1930s, the New Deal. The U.S. government expanded its debt in a way that we had never seen before outside of wartime. And what did Treasury rates do? Despite all the people yelling about how the government was going to bankrupt the nation, what did Treasury rates do in the 1930s? They went down and down and down and down. So we have all of these examples, and it is incumbent upon people to understand the examples. First of all, be aware of what they are, but also how can that be? As you're doing, George, you go through the exam, you go through the, think through these processes. Do the people really care that the federal government's deficits are going sky high? Well, people who care are the people who think that, oh, government deficits lead to financial collapse. Well, in some cases that can be true, but it's not true in the vast majority. So it's that you have to get past that emotional intellectual roadblock.
I've got an idea. Let's tackle this a slightly different way, because I think most people look at this through the lens of basic supply and demand. So they say, okay, Jeff, China is dumping Treasury. Let's just assume that's true. We've got foreigners that are no longer wanting to accept treasuries for XYZ reason.
See, that's the other problem, George. There's too many assumptions.
I get it, but let's just assume this is true, right? But what's definitely true is that the deficits in the supply of treasuries is increasing massively. So let's just say that let's go back and say that China has the same appetite for treasuries, but we're increasing the supply. The supply is going straight up. Well, common sense would say that, okay, prices are going to go down. If you have the supply going like this and demand is staying here, then prices are going to go down. In other words, interest rates are going to go up. And so that's why I think so many people struggle with your argument, with my argument, is because they're like, look, you're admitting, Jeff and George, that supply of treasuries is going to go up. You're admitting that. So how can you not come to the conclusion that interest rates are also going to go up and prices are going to go down? So I think the disconnect for people is how you can have an environment where an increase of supply actually increases demand at the same time. So I've got my way of explaining that. How do you explain it?
It's just what we talked about. It's the fact that doesn't matter how much supply comes out. Everybody focuses on the supply aspect of it and never focuses on the demand aspect of it. That's the real big issue here, is that you think and it's part of, the problem with economics. You're taught to think of everything ceteris paribus, all else being equal. So all else being equal, if the federal government increases supply, all else being equal, the price is going to go down. But that we don't live in a world where ceteris paribus applies. It never does apply. There's a concept that used to be relatively well known in economics called crowding out. What that simply said is that because the government has the preeminent form of safety, these liquid as instruments that we call treasuries, the more treasuries they get issued, the more in these environments, these depression economics, the greater the demand will be for those treasuries because of the fundamentals of supply of growth and inflation expectations. So the more, you look at the banking system at the end of the 1930s, for example, you look at the balance sheets of all the banks across the entire country. About 75% of those balance sheets were U.S. treasuries, because the more the government issued, the more the banks said, buy treasuries and every last dollar that's coming out of FDR's hands, or invest in, some kind of, a real economy project during the depth of the Depression. Give me more treasuries. Keep piling them on my balance. I don't care how many you've got. Give me more. You got another 100 million? I'll buy every last one of them. So when the Treasury Department is supplying treasuries, it is giving the market what it wants. So it doesn't matter how much is supply. The market is saying, give me more, I want more. Look at Treasury bills. Treasury bills is absolutely insane. Give me more, I need more, give me more. So the problem with that argument is everybody assumes that supply is the individual factor. It's the only factor that you need to consider. And so yes, ceteris paribus, if there's more supply, then prices will go down. But it's a wrong assumption from the start. The assumption is that there won't be demand for supply, and that is just absolutely, not is it just wrong, it is demonstrably false. So we have these periods where it doesn't matter how much supply comes from the government. And this is not a good thing, by the way. We're not saying this is positive. We're not advocating for this. What we're saying is this is how the situation, or this is how the system works under these conditions. And there are all sorts of bad consequences of it, but you shouldn't be surprised when it doesn't impact interest rates. In fact, what you should do is say, why didn't it impact interest rate? Why does there always seem to be so much demand for whatever the government supplies? That's what should really happen, not say, oh, well, next year suddenly supply will matter. So it's always a focus on supply and never really thinking through the other side of it.
That's what I try to get through to people, and I try to get them to think about is,
well, George, it's impossible when everybody thinks that we're in an inflationary environment. So for an inflationary environment, supply is absolutely going to matter. You see what I'm saying about these? Too many heuristics, too many assumptions that take place, and not really stopping and putting all of these pieces together and looking at all the evidence and putting all the evidence, it's really easy to fall into the trap of compartmentalizing something. You look at gold and gold going up, and that confirms your bias for inflation. Say, okay, gold is going up. So it can only go up because of inflation. Therefore, I'm going to look at the entire world because gold is going higher. Therefore, the currency must be debased. And so that confirms my theory about what's happening in the marketplace. And I'm going to ignore all the evidence over here that says that gold is not going up because of inflationary purposes. I think that's the major problem is you compartmentalize, confirmation bias, way too many assumptions, and the ability in the, again, human nature to rationalize away all the stuff over here that doesn't agree with this idea that you've got over, the main idea that you've been working
I
toward.
think people just have to ask why. If you're trying to predict the future of interest rates, you have to go back and acknowledge the fact that since the 1950s, probably going back a lot further than that, that's the chart I have, that the 10-year Treasury yield has tracked nominal GDP. So if you want to predict the future accurately, or as accurately as possible, your starting point has to be understanding why that happened and why the mechanics behind why that happened. And it's not the petrodollar. It's not the fact that, because if it was, but let's just, let's humor them here for a second. It's not the petrodollar, because if it was, then you wouldn't see it just track with nominal GDP.
There would be a clean break in the 1970s.
And if it was just, China buying our debt, well, then that wouldn't necessarily track exactly with the nominal GDP. So it has to be something other than that.
It has to be something fundamental. That's really the key here.
Yeah. Or I always use the word mechanical, but that's basically the same thing. And then once you understand why that happened and you can explain it well, then you can go ahead and say, okay, what's the probability of this continuing into the future? And, I had a quick conversation with our buddy Mike Green in St. Bart's on this. And he says the way he looks at it is, if the government is running a huge deficit, that implies that the conditions in the overall economy are going to lead to there being more demand for treasuries. Because if there was less demand for treasuries, then the deficit probably wouldn't be exploding. And I think it's the same way, or a slightly different way of saying what you're saying. And the way I always look at it is, I always say, or the way I kind of try to picture it in my mind and explain to people is, unfortunately, supply creates its own demand from the standpoint of, if you got nominal GDP, let's just say at 4%, and that's the expectation moving forward. And if supply, let's say we do have this deluge from Besant, and that creates an environment where temporarily, or on the short term, the 10-year Treasury explodes. Let's just say it goes up to 8%. Let's just say that hypothetically. So you got nominal GDP at 4, you got the 10-year Treasury trading at 8 because of all this supply that just hit the market. Well, what is everyone going to do? Especially the banks that just pocket the spread. They're going to buy treasuries hand over fist, because now there's a better arbitrage opportunity, and that's going to take those interest rates right back down to wherever they started. Let's just say at 5% or 4% or whatever it was. And so that's why I always say that supply of treasuries creates its own demand. And that's, I think, if people can get their head around that, that will help bridge the gap as to why a massive additional supply of treasuries might not lead to lower prices and might not lead to higher interest rates, because in that environment, the probabilities are extremely high that demand goes up at the exact same rate, if not higher.
Or close enough to the same rate that you don't see an instability in the marketplace. I mean, that's what we've been hearing all year, right? The world is rejecting treasuries, even as long-term rates continue to go lower. The world is rejecting treasuries, but we see no dislocations in the market, which is why you hear, oh, this auction had poor results and that auction had poor results. Okay, if that's the case, why didn't it make any impact in the marketplace? Why did rates still continue to function relatively well, smoothly, and rates go down? I think that's exactly the right thing that you need to do, George, is to ask questions about, okay, I hear all of this stuff over here about how this is supposed to work. Why didn't it? I mean, think last couple of years, all we heard was that when the Fed turns off its QE, plus the inflationary conditions after the pandemic, interest rates had to skyrocket. Well, the Fed stopped QE. The Fed's been doing QT, and interest rates continue to move lower over time. So why didn't it work out the way that everybody said it was going to work out? You have to ask those questions instead what happens is they move the goalpost a little bit further into the future and say, oh, well, this is just a delay. The dollar's going to crash next year. I said it was going to crash this year, but it's going to crash next year. You have to stop and say, okay, we've been hearing the dollar's going to crash and the treasury market's going to crash every year going back to 2008 and 2009. And every year the opposite.
1980. Are you kidding me? I mean, I don't want to make fun of the New Orleans investment conference guys because a lot of them are my really good friends there. But a lot of people, the gold bugs, that crowd, they've been saying this since the 80s. Even back in the Market Wizards books, and those were late 80s, early 90s.
Oh, yeah.
The legend. I remember reading Druckenmiller's interview with Jack Schwager, and he was talking about how the deficits are going to lead to the demise of the dollar, and all these things. And that was Druckenmiller, for heaven's sakes.
You remember George in the 1990s. The gold people were convinced that the Fed was manipulating the price of gold because of that, right? The deficits in the 80s was going to lead to exploding dollars and exploding treasuries, and that we didn't see it in the gold signal because gold was being manipulated by the Federal Reserve. I mean, that was taken for given by a lot of people. There's the one testimony by Alan Greenspan in Congress where he said that if we have to, we can just lease gold into the marketplace. He was talking about when if anybody tried to corner the gold market, they wouldn't be able to. And everybody's, oh, see, the Fed is admitting they're manipulating the gold price. Right. No, the gold price was simply saying the deficits didn't matter. The world was booming. Prosperity was legitimate and it was widespread. So nobody needs to own a safe haven like gold. And by the way, you don't need to own a safe haven like treasuries either. Where were treasury rates in the 1990s? They were significantly higher than we have here today because it was relatively, was a legitimate booming period. But you're right. There's all sorts of these it's economics is complicated. Finance is even more complicated. And the monetary system is a complete dark spot. It's a complete black hole. People have no idea how it works. So it is understandable that you come up with these shorthands about how you think it's supposed to work using historical examples, and usually a small subset of historical examples, not realizing that, first of all, those are only a small subset of historical examples. There are a lot of other examples that you're not aware of. And by the way, the monetary system is nothing like what it was, back in the 19th century, or even the earliest 20th century. It doesn't work the same way as it did. So there's a lot of different things that have taken place that these assumptions that people have about how it should work just don't apply. And that's why they never work out.
And from a psychological standpoint, as far as just human psychology, I find it fascinating because it's more than that. Because the starting point is what you're talking about, but then it becomes exacerbated because it's so obvious based on the rationalization that people just assume that it's true, and then everyone says it. And everyone says it over and over and over again, to then you have someone new coming onto the scene and they don't even bother to research it. They never look beneath the hood because so many other people are saying that this is the way it works, that it has to be true.
Everybody can't be wrong.
Yeah.
No, it's what it is, because these are incredibly complex topics. Like anything else, you're depending upon expert opinions, right? You're thinking, this guy over here sounds like he knows what he's talking about. Therefore, he must have done his homework. He must have gone through this, all of the processes that we're talking about. He must have gone through all the primary source material throughout the history. He must know what he's talking about.
And you don't realize he's just parroting other people.
Yeah, I don't have time. It's understandable. I don't have time myself to dig into these topics. So I'm going to listen to somebody who sounds like they know what they're talking about, and they kind of conform to my own biases. Therefore, he says it, and this guy over here says it, and it must be true because everybody says the same thing. It's funny how that rationalization is more powerful than the fact that what they say never happens. It never happens.
Right.
And yet, it's just next year. It's going to be the next year, the year after that, or the year after that.
Yeah. I was reading a study. This would have been, I don't know how long. It was a long time ago, before I retired and before I got into all this. But it was
back when you were happier.
Yeah, it was on cognitive dissonance. And it was, it was on cognitive dissonance. And it was, it was on cognitive dissonance. And 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 it was on cognitive And so what happened, there were a group of psychologists or psychiatrists or whatever, whoever studies this stuff, and they followed around a doomsday cult. And this doomsday cult believed that the world was going to end. It was like, so in like 2005, it was something like that, right? So the year leading up to the date when they thought the spaceships were going to come down and the world was going to end or whatever it was, the psychologists, the mental health professionals, they were following around. They were taking down notes and all these things because they assumed that the world wouldn't come to an end, and they had all these hypotheses as to what's going to happen. And some of them thought that the people would just wake up and be like, oh well, I guess we were wrong. And then the other hypothesis was, well, maybe they won't, maybe they'll double down. And sure enough, that day came and passed, and as we know, the world didn't end. And so then the psychologists interviewed, the people in this doomsday cult, and like every single one of them just doubled down. Every single one of them. Like not one of them said, oh, I guess we were wrong. Let's just figure out why. Every single one of them said, oh, well, we must have just got the date wrong. Or they they must be, the spaceships. Well, they're not only
changed their mind,
but now they're taking out, all the other planets or whatever it was. But they just rationalized it because the cognitive dissonance was, they couldn't bear that. That like the mental anguish that would create, it's unbearable as for human beings. So we have to just invent a counter narrative with these mental gymnastics. And I think it's pretty much the exact same thing as in economics.
Yeah, I was having a discussion in Dallas at Kenny McElroy's thing, Limitless, which is great, by the way, with an Austrian author, and he was, talking about Cantillon effects, which is a big topic among the Austrian economists, and it's understandable why that is. And he's going on about how banks, old bastards and greedy bastards, are leeches on society. And I said, well, let's think about this for a second. The banking system developed a correspondent network that allowed the entire, at the time, the country in the 19th century was more of a patchwork of regional economies.
Yeah.
And as it started to grow and become more sophisticated, it required monetary systems to be able to, enact payment from one side of the country to the other. And so you have this patchwork of individual banks that got together and created what was at the time a very sophisticated payment network. This was the correspondent system, and it had hierarchies and it had methodologies. It even used, brand new telecommunications technology. So yes, there's Cantillon effects, but maybe the Cantillon effects were the way the banking system got paid for operating a payment network that created a tremendous benefit to the overall economy.
Right.
When I said that, his eyes just glazed over because he'd never thought that before. The thought never even occurred to him once before, and he just got up and left. So I think we're done here, and got up and left. The idea that his position, that there was some other explanation for why this took place, that it wasn't just this bunch of evil, greedy bankers who were leeches on society, that they were actually providing a necessary benefit to the progress of human civilization, never even crossed his mind. And when I raised that issue, you could tell it was so uncomfortable for him to hear it. He just, I'm out, I'm done. I got to go someplace else.
Yeah. Yeah. And so I think the moral of the story there for the viewers is try not to let yourself fall into that bad habit. That we're all kind of hardwired to, we're all hardwired that way. Just realize it and try to be as objective as possible. I think that's really what I'm trying to say. And I think a lot of viewers might say, well, George, okay, I understand what you and Jeff are saying, but who cares? I mean, understanding all this monetary stuff, how is it really going to help me in everyday life? And for those viewers, I can tell you that
look at New York City and Seattle. That's how it's going to help you.
Well, but also from a standpoint of your portfolio, because if you understand what we're saying, you're going to have a much better understanding of interest rates. And then you're going to have a much better understanding of what those interest rates are telling you about the economy. And then you're going to have a huge edge as to setting up your portfolio if you're able to interpret the messages and the signals that you're getting from interest rates. But if you're caught up in this, that the interest rates are doing X, Y, and Z because of debt and deficits, then you're blinded to the reality, and you don't have that edge. And I know over the past year or so, I mean, knock on wood, I've been doing extremely well in my portfolio, and I can attribute the majority of it to just understanding these things that we're talking about on this video, paying attention to interest rates, and just listening to what they're telling me.
I would, that's absolutely, I mean, for people who are investors, that's absolutely the case. But I think it goes beyond that, George. Why is there a socialist, an out and out communist, now the mayor of New York City, in Seattle? And people on the right cannot fathom why that's the case. And the answer is in the interest rate market. Why is everybody so intent on owning safety and liquidity? Because the economy sucks, and it has sucked for so long. You imagine being a 20-year-old or a 25-year-old in this economy. People on the right don't, I mean, they hear Jay Powell talk about a booming economy. President Trump says it's booming. It's the greatest economy we've ever had. So it's a disconnect there as well. How can the younger generations be falling for this fallacy of socialism? And it is a fallacy. Socialism is one of the biggest evils that humanity has ever created. So you think, how can this possibly happen? Well, it must be colleges that are just indoctrinating people. No, it's the reality. The interest rate market is telling you the economy sucks. And so imagine you're a 25-year-old. You just out of college. You got lots of debt because that's what you're supposed to do. You have no job prospects. You're working at Starbucks. I know you use the stereotypical example. You're living in your parents' basement. You have no hope of ever owning a home. You're not even sure you're ever going to be able to buy a car. And what do you see on TV? What do you see in social media? You see cryptocurrencies flying. You see the stock market soaring. You see all the politicians and the officials saying how great it is. Socialism doesn't sound that bad in that situation. So understand what the markets are telling you beyond just your investment portfolio. They're explaining the entire friggin' world to you. Why do we have such political instability all over the world? Well, when the rate of change in the economy goes down, the rate of instability in politics goes way up. So it's a way, it's sort of like the North Star for navigation. Whether it be in investments or economic interpretation or in just political commentary. You look at the interest rate market, understand fundamentally what it's telling you. It is a very good guide to at least start building some kind of a picture of where you think everything is.
Or with your business as well, Jeff.
But yeah,
remember what we were talking about before, the bullwhip effect and all of this massive aggregate demand that was a result of government distortions. And this was a sugar rush. So if that business owner, we'll talk about the restaurant guy. If that restaurant guy, instead of looking at his door, seeing this long line, thinking that that's going to last forever, therefore I've got to set up more locations and hire more employees. If he would have just looked at the yield curve and been like, whoa, wait a minute here. This does not look right. And so I'm going to go ahead and pump the brakes a little bit. I'm going to enjoy this demand, but I'm going to stockpile cash for a rainy day. I'm going to try not to hire more employees, and I'm definitely not going to start that new location or set up that new location until I see the yield curve look more normal, let's say.
Even though I've got private credit guys on the phone trying to lend me money to do that.
Yeah. And it would have turned out a lot better for them. So anyway, we've been going on a long time, Jeff. For people who want to find out more about what you do, where can they go?
Just Eurodollar University, either the website, eurodollar.university, YouTube channel, Twitter, X, whatever it's called nowadays. I'm at Jeff Snider _edu on X. Just Eurodollar University.
Yeah, and the podcast is great too. It's on iTunes. Every single morning when I work out, I usually just throw on your podcast really quick. So people can find you there. All right, buddy. Thanks a lot. Have a good one. And for all the viewers, make sure you're standing for freedom, liberty, free market capitalism, and we'll see you on the next video.